Ladies and gentlemen, good day and welcome to the Shriram Properties Limited Q3FY22 Results Conference Call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Adidev. Thank you, and over to you, sir.
Yeah, thank you everyone for joining us on the call today. On behalf of ICICI Securities, we are pleased to host the management of Shriram Properties on their maiden conference call to discuss the Q3 FY22 results. From the company management, we have with us today Mr. Murali M., the Chairman and Managing Director, Mr. Gopalakrishnan J., the Executive Director and CFO, and Mr. K.R. Ramesh, the ED of Operations. And now I'd like to hand over the call to the management for their opening remarks. Tell us a little bit about the company, how the quarter has been, and how the road ahead looks. Over to the management. Thank you.
Thank you, Adidev. Good evening, friends. This is Murali here. I am pleased to welcome you all and thank you all for joining our first investor analyst earnings call post our listing. We specifically thank ICICI Securities for hosting this event and especially thank Mr. Adidev for moderating the call today. Friends, I am sure you all have seen our press release for Q3 earnings and also assume you have accessed the presentation uploaded on our website as well as that of stock exchanges earlier today. Friends, overall it has been an encouraging quarter for us as we have reported positive net earnings consistent with our expectation of turnaround the year FY22. Our focused efforts to ramp up and build scale, leveraging strong operating platform built in the recent years are yielding results. I am very happy to state that despite macro headwinds, we have been able to deliver very strong volumes both during the quarter and for the year to date. Stable quarterly sales run rate of 1 million square foot plus is quite encouraging. Our execution ramp up in the recent quarters have been very satisfying as well. Supported by very strong project pipeline, we are confident of sustained growth momentum. Improving scale, operating leverage, and rising share of development management income should help in improving profitability further. We believe we are on the right path to sustained profitability. I'll request my colleague to walk you through the overview of Shriram Properties and also to highlight the performance for the quarter and the year, as well as the strong visibility we have on the earnings over the next year or two. I will request my colleague Gopal, who is the ED and CFO, to go through a brief presentation. After that, I'll take questions that any of you have, and we will be equally keen to continue our interactions even outside this call in the coming days to ensure that you'll be able to appreciate the compelling investment case in Shriram Properties Limited. With this, I request Gopal to make the presentation, please.
Thank you. Thanks, Murali. My name is Gopal, and I am going to use the presentation that is already on BSE NSE website. So I might refer a few page numbers from there. For the next 20 minutes, I will try and walk you through our current performance as well as outlook. Starting with page 3 of the presentation, as an introduction, we are a pure play mid-market affordable housing company from the south and one of the few truly professionally managed real estate player in the listed space at present. We are part of the Shriram Group, backed by a globally renowned PE investors who own 35% of the company even post-listing. We are among the largest top 3, top 5 players in each of our core markets. As I said, we are a pure play mid-market housing company. 90+% of our portfolio historically has been in mid-market affordable housing space. Will continue to be in the same space with 87% of our portfolio forward as well. We have demonstrated our track record over the last few years. We have ramped up quite aggressively post-RERA, taking advantage of the consolidation going on in the industry, and we have scaled up very nicely and stabilized at a higher level. To sustain that growth momentum, we have built a very strong pipeline, 35 projects, 47 million square feet of development potential, over and above a small residual land bank that we have, or FSI sale potential that we have in the only land bank that we have in this company. To clarify, we are not a land banking company. We primarily acquire land parcels for projects. Barring exception of Kolkata, we have no land bank in the company's portfolio. The other theme that we have followed for 20 years is the asset-light nature of our business model. We have always traditionally focused on JV, JDA. About 87% of our portfolio is in that JV, JDA space. And we also kind of pioneered the development management model in the southern part of the country, which is about 3 years ago. That has actually stabilized very nicely. Is making a material impact now, which I'll walk you through as we go through in this presentation. Just looking at the slide 4 of journey so far, as I said, top 3, top 5 player, mid-market player, and established leader in southern regional markets. Strong execution platform built consciously over the last few years, to take advantage of the consolidation that is going on in the industry. We have incurred some significant management time, energy, and costs in building this platform, which we believe is now well set and well oiled. Therefore, improving scale and efficiency and the strong pipeline that we have, our margins are poised to grow, and the beginning of that was evident over the last couple of years, and on a quarterly basis we have been improving our overall scale, revenue recognition, as well as we are able to see now a material impact or material improvement in our profitability, which we believe is sustainable. Looking at the operational highlights for the quarter and the 9 months on slide 6, our overall volumes for the quarter has remained very stable at that 1 million mark on a quarterly basis. We have been working consciously towards stabilizing first at that 1 million plus mark on a quarterly basis, and we have been able to reach that despite the macro headwinds that we have been seeing over the last few quarters. On a year-on-year basis, if you look at on a 9-monthly together, we have achieved about 2.6 million square feet of delivered of the pre-sales, reflects a 56% growth on a YOY basis. We have, on a sales value basis, it's about 1,000 crore sales value we have achieved. I must clarify here quickly that the sales value is a combination of both our apartment sales as well as plotted development sales, and therefore you would get a misleading number when you divide the total sales volume by sales value, and therefore I would request you not to jump to a conclusion on the sales realization by dividing these numbers. On a constructed basis, if you look at, our average realization is about 4,500 rupees per square foot for constructed apartments. Plotted development we sell anywhere between 1,800 rupees to 2,400 rupees per square foot depending on the micro market. So the blended average realization is what you will see here as a sales value. On the collection front, the quarter has been extremely good as well. 314 crores of construction spend, up nearly 30% year quarter on quarter from Q2 to Q3. Q3 to Q3 current year versus Q3 last year. On a 9-month basis, if I look at, we basically have 843 crores of total collection this year, reflects a 64% growth year on year. On the construction side, we have actually made a remarkable improvement in construction during this quarter as well as during the first 9 months of this year. Construction spend has nearly doubled to 137 crores for the quarter and 423 crores for the 9-month period. You would notice in the presentation that 250 crores was the full year spend last year. That clearly shows that we have managed to overcome the challenges of labor migration that we saw last year, post-COVID 1.0. We now have 5,000 laborers that are across all our sites as compared to 4,200 labor pre-COVID. So overall, operationally, the quarter has been good and also the 9 months has been extremely encouraging. We believe the momentum will continue. We had a very good successful launches. For the quarter, we had for the 9-month period, my apologies, we have very successful launches as highlighted in page number 8. About 8 of them All of these launches have delivered a very good response to us. What we measure ourselves is a metric called sales at launch, which is nothing but the actual sales realized in the first 90 days of launch, formal launch. And we have consciously tried to reach a 35-40% number in each of our projects over the last 3-4 years. We have stabilized in that 30% plus range. During this year, it has been more encouraging. The weighted average sales at launch has been around 45% for the first 9 months, which clearly means the project, when you get a 50+% of sales volume sold at the launch period, and you do a subsequent sales in the remaining 3-4 months period, first 6 months if you achieve 50-60% of the project inventory is sold, that actually de-risks the project as the collection from customers and a very marginal working capital or a construction finance required would take care of the project execution. That has been a conscious strategy that we have built, and I think it's working very well. You have heard us talking about DM consistently over the last, through the entire roadshows as well as in subsequent communications. DM has been a strong growth driver for us, and we believe it will remain a growth engine for Shriram. What do we do in DM? We provide end-to-end solution to our customers, which is primarily the smaller developers and the landowners. We take over the project from them. The land is owned by the landowner company, SPV. We become a contractor. We provide an end-to-end solution for them, right from project planning, product planning, launch, sales, collection, construction, execution, and handover. Everything is done by Shriram in the brand of Shriram. Landowner remains at the end of the waterfall as a residual beneficiary of the project cash flows. And therefore, this model has worked very well for us over the last 3 years. Today, it accounts for 1/3 of our project pipeline. As you could see from slide 9, between 35-38% of our sales volumes on any period that we look at is now in DM model, and DM revenues account for about 22% of overall revenues as well. We believe it's a scalable, sustainable, and a profitable model, and we'll continue to focus on it as a future, while remaining focused on JV and JDA as our other alternative formats of development as well. Turning to page 10, we have built a very strong pipeline, as I said in the opening remarks. As you might have seen from the RHP and we have 35 projects, 47 million square feet of development potential, well spread between ongoing and the future projects. 26 out of 46 is the ongoing projects, of which 21 million has been launched. Remaining are the additional phases of an ongoing project, so they are yet to be launched. Out of the 21 million square feet, 85% is sold. Remaining 15% will be sold as we progress the construction, as we go through the project life cycle over the next year or so. Which basically means we have a very small residual inventory in these ongoing projects. Number 2, we do not have inventory in completed projects. That's a big positive for being a mid-market affordable housing player. Therefore, the future growth pipeline will help us sustain growth momentum, as we have only 15% of ongoing projects as left as a sustainable sales. And that's why the forward pipeline becomes very important for us. We have a nicely stacked up projects which are PUD, means projects under development, as disclosed in the prospectus. These are all the approvals, all the land, everything is under control. It's waiting for some last set of approvals or registrations with RERA. So they are getting very close to launch readiness. FC, which is basically a forthcoming projects, means projects are still being baked. It might need some last leg of approvals may be pending. In some cases, maybe a last milestone, last leg of land acquisition might still be pending either by us or our JDA or our DM partner. So those, they are probably still some time away from launching. So we have nicely stacked up a maturity profile where some part of the pipeline is ongoing, some are projects getting ready for launch, and some are actually will take another year or so to get ready for launch. So that we believe should help us in continuous launches and therefore sustain momentum. After filing RHP, or since November when we filed the RHP, We have signed more projects, as you can see from slide 11. We have signed 5 more projects, adding up to or aggregating to 2.3 million square feet of development potential, both in Chennai and Bangalore, both in the DM and JDA formats, and they are at various stages of launch readiness, and therefore they would actually be taking off on a nearly immediate basis. In addition, we also have another 11 or 12 projects at an advanced stage of closure. We'll add another 10 million square feet of development potential across models, both JDA, DM, as well as some of them are our own. So all of this, we believe, should consummate and result in a very strong, robust pipeline for us before the year end. That will support the accelerated growth that we are targeting. Even with that level of enhanced volume, it will support us for the next 3 to 4 years in terms of growth. So I think the growth ingredients are already in place. I'll talk about the execution and therefore earnings visibility. But before that, I would like to walk you through financial highlights, both for the quarter and for the 9-month period. Slide 13 gives you a snapshot of how the quarter has been. As Murli said in his opening remark, this is after a gap. This is our first quarterly positive earnings. That turnaround is very encouraging. We believe this is just a beginning, as expected and as indicated through the entire roadshow process. We are on a path to recovery, and we believe with the improving scale. I'll talk about the drivers behind the past, but fundamentally we lacked operating scale because we are building the organization for a 5 million square foot of throughput on an annual basis. As you would know, AS 115 forces us to recognize revenue only when you complete and hand over. The historical volumes that we did in 2016, 17, 18 is what is getting handed over. And those projects actually, therefore, the scale was missing. With having sold almost in the 3 to 3.5 million square foot range over the last 3 years, they all are coming up for completion and handover over the next 24, 36 months. All of this, I'll give you some of these numbers as we go through, but fundamentally, these are improving operating scale, rising share of DM fee, which is a fee income and therefore flow through the P&L. Combination of these two should help us see EBITDA margin stabilizing at a much higher level. On a full year basis, we believe we should be able to be in the mid-20s or higher than that levels, and we should be able to stabilize fairly quickly. Q3, if I look at a very current quarter alone, if I look at Q3, our total revenues have been 1.3 billion or 130 crores, and we reflected a quarter-on-quarter growth of 38%. On a YOY basis, the numbers were slightly lower, primarily because the overall revenue recognition or the registration that we did is lower during this current year, because last year we had a much higher Q3 registrations as a result of the pent-up registration demand. Meaning the first 6 months of last fiscal, we lost 5 months out of the 6 months because of the COVID. Register offices were closed, and therefore there was a lumpiness in the overall registration in Q3 last year, and therefore we had a year-on-year drop. But overall EBITDA, if you look at, we have on a current quarter against 130 crore of revenue, EBITDA is about 53.2 crores or 532 million, reflects a very strong growth both on a QOQ and YOY basis. EBITDA margins are higher than what we believe should be a normalized EBITDA, primarily because we were able to income recognize in some of our plotted development in a micro market that were high margin markets. We had a Shriram Earth Whitefield, where we had our own plotted development which came in for income recognition this year, revenue recognition this quarter, and that being given the micro market that you all are fully aware, it's a high margin micro market, and therefore we had a higher margin. Second, as you would have seen from the notes to the accounts, one of the projects where we surrendered or we renegotiated the development rights, we acquired phase 2 and phase 3 of the project as our own JDA, and therefore we completed and partly completed and handed over DM rights in one of the first phases of the project called Divine City in Mangadu in Chennai. As a result, we had an income recognition of 12 crore there. As a combination of these two put the EBITDA margin at a higher than usual number of 41%. We believe mid-20s is the margin that I think is sustainable on an annual basis. We had negative earnings in the past, as I explained, because of the operating scale mismatch between the earnings that we are recognizing, current cost, historical sales volume related recognition. That's a basic simple one-line summary of why we were suffering in the past. So we have turned around, and we believe this will be a sustainable turnaround. And as we have been maintaining through the entire roadshow, that FY22 would be a year of turnaround for us, and we see a very strong growth in earnings with revenue recognition of all of volumes that were sold over the last 2-3 years coming up for income recognition in FY23 and 24, and therefore we see the momentum continuing. I'll go a little more in detail in the next slide, but fundamentally page 14 gives you a very simple summary of the entire P&L that we have. As I said, positive earnings, encouraging turnaround consistent with our expectations, improving operating leverage and rising share. I'm on page 14, slide 14. Improving operating leverage and rising share of DM income supported higher profitability and earnings for us. And individual component, if I look at, as I said earlier, pent-up registration from H1 helped us recognize more revenue this year. But more importantly, on a year-on-year basis, it suffered primarily because last year was a higher base in terms of number of registration that we did. Other income is lower primarily because of our other income primarily consists of interest income, short-term loans given to JVs, as well as in some cases to the DM partners, DM projects, where it might be waiting for its own financial closure, and so we might have extended short-term loans to them. Otherwise, we don't have exposure to DM projects financially. Overall cost growth has been slow. It primarily reflects the nature of projects that have come up for income recognition. Operating costs are up only 7%. Employee costs lower marginally. That reflected improved EBITDA margin that I said a few minutes ago. We are working towards bringing down interest costs, but fundamentally current interest costs are marginally lower, 12% lower on a QOQ basis. And we believe the interest cost will drop consistently as we go through the IPO proceeds related prepayments, as well as some debt restructuring or debt refinancing that we're trying to do, move away from NBFC focus to a bank focus, because we don't have a land related low debt in our books. It's all project specific construction finance, and therefore we should be able to move to bank funding, especially having become a listed company with whatever the credit rating that we have as BBB+. We should be able to refinance them in a banking market, and that should help us bring down finance costs. So overall, if you look at encouraging Q3, slightly lower year-on-year on most metrics on a YOY basis for 9-month period. Revenue from operations down 22% year-on-year, largely due to some delays in registration revenue recognition in some projects, notably Southern Crest and Grand 1. These projects were originally scheduled for this year's first half, and then got postponed to 3Q registration. That has got further postponed to year end, primarily because of labor migration last year set us back in terms of construction milestones. They're now catching up, and therefore we should be able to get a few months of movement here and there. We are now back in control in terms of construction activities. Pre-COVID, we had 4,200 people across all our sites. Went down as low as 900, as you would have heard from other listed players. Went down as low as 900 plus, and therefore construction milestones had to go through a little bit of revision. But we got them back quickly in 2019. November 20, we got most of the labor count back. Jan 21 onwards, we have been having a rising trend. Started with 4,500 in January, and now we are standing at 5,300 people across all sites. So we're back in control in terms of construction progress, and therefore we should be able to recognize income in Q4 as well as in Q1 some of these projects. EBITDA has remained flat. EBITDA margins are about 31% in 9 months. As I said, we would strongly urge you to consider mid-20s as a more sustainable margin for this company. If I move to the next slide, cash flow, which is more critical in our business, as you all appreciate. So we had a fairly positive cash from operations this quarter. We have been having an improving trend in operating cash flow from operations, and we had an improving trend and an encouraging trend, and that continued even in Q3. We see this trend continuing in Q4. Actually, in Q4 we will have a much larger positive cash flow because one of our DM projects is nearing closure. This is an office complex in Chennai, and those cash flows will also start coming into us in Q4 and Q1 of Q4 of this year and Q1 of next year. So overall, we see a cash flow profile very strong. As you might be seeing two tables in slide 15. The table on the left is actually SPL consolidated. Table on the right is the SPL along with the 100% share of JV cash flows, because that's our control cash. Because these JVs are joint venture with the landowners, and therefore these are control cash by us, and that shows the true picture of our operations. And if you look at that, it continues to have positive cash from operations as well as a strong liquidity at around 365 crores. That's across all our operations as of the December quarter end. We see the liquidity remaining strong and improving, in fact, as we go through. Shifting to balance sheet, we have traditionally had a low gearing in our company. Prudent practice, same value system that we follow across the Shriram Group. Low leverage is always beneficial and prudent in our business, and it's in a debt-heavy sector, and therefore low gearing level will always ensure competitive advantage for us in the marketplace, and that's we're continuing with that strategy. We post all the IPOs as of December. The IPO proceeds were in cash and cash equivalent, and the net debt is at 0.3:1. Post December, we have repaid some of the loans which were intended for the part of the IPO proceeds were intended for prepayment of loans. We have done about 140 crores of prepayment in January. We intend to do remaining 60 crore repayment during February and March, and therefore by year end our net debt will remain around the 300 crore mark, but cash and cash equivalent would have been used for repaying gross debt. So interest burden will come down for the full financial year next year. Apart from that, as I said, we have a strong operating cash flow coming in with closure of projects. Therefore, we have enough growth funding as well available, and our interest burden should go down with the refinancing efforts that is underway. If I shift gear and talk about what do we see for the next quarter and few more quarters to come by, very briefly I'll touch upon slide 7, and then I'll cover longer term outlook in a slide further down. Q4 visibility remains strong for us, fundamentally based on the volume that we have sold over the last 2-3 years and the execution schedule that we have, which we believe we are back on track now post-COVID aftermath. Therefore, we see a very strong revenue recognition visibility, and that should actually give us enough headroom for Q4 revenues and also EBITDA. Looking beyond, the strong volume outlook is also actually supported by 3 planned new launches during Q4, as well as we have a few other additional launches prepared. If the market window permits, we are fully prepared to do additional 3 to 5 launches. These are multiple phases of current ongoing projects where the inventory is almost over, and therefore we would be prepared to launch additional phases of these projects. So overall, supply side, we have enough supplies fully baked. Therefore, we should be able to achieve the targeted volume. As we have said consistently, we are targeting to have 25% to 30% growth in our volume for this year, targeting to close this year with about 4 million or thereabouts, and growing to about 5 million or thereabouts next year, and sustain the volume growth momentum at around 20-25% on a 3 to 5 year basis. From a collection outlook shorter term, we have, as I said, we have caught up with the construction milestones. Construction spend is a clear indicator of how aggressively we have caught up. Our 9-month spend is far in excess of what we did the whole of last year. We expect to reach close the year between 500 to 600 crores of construction spend, which basically compares with 250 crores of construction that we did last year. So nearly doubling our construction on a full year basis also we believe is possible. And collection outlook is also equally encouraging, with milestone being caught up, demand notes going out. We see collections actually strengthening as well as we go through the rest of the financial year and next. From as I talked about our strong visibility, we have 5 projects will account for 80% of Q4 revenue recognition. Of this, 2 projects are just waiting for OC. Southern Crest in Bangalore, Grand City in Kolkata. Both are waiting for OC, and we expect them in Q4, the remainder of Q4. Therefore, they should start getting registration process beginning. The other 4 projects that are planned for revenue recognition, Vizag, 1 in Bangalore, and 1 plotted development that we started already. All of these are only registrations are pending. Therefore, the bottom line I'm trying to highlight is the revenue recognition visibility is there. Under 115, we should be able to recognize as we complete and hand over these units to our customers. DMP is an integral part of our growth and our revenue strategy. We see a very strong outlook for DM. Over the last couple of years, we've had grown the DM fee income consistently, and we see 120 to 150 crore annual DM fee potential based on projects signed already. I'm not including the projects that have been signed post RHP or post prospectus, but notwithstanding that, we still have a very strong DM recognition potential, and that should be stabilizing around an annualized rate of about 120, 150 crores. Q4 also we see strong potential from these DM projects. Looking a little longer term, a very important point for us, we believe the aspirational growth that we have, and we've scaled up to it, right? We've been targeting to reach this 4 million square feet very comfortably, and I think despite COVID, despite NBFC crisis, despite these repeated interruptions from COVID 1, 2, and now Omicron, we still have been able to sustain this 1 million square foot per quarter run rate. And therefore, we believe we should be able to maintain and grow from here. And to support that, we have enough projects coming up. Ongoing projects aggregate to about, as I said earlier, 26 million is ongoing, 21 is launched, 85% is sold. Based on these projects, therefore, when I complete and hand over, I will revenue recognize. We believe over the next 24 months, 15 to 18 million square feet will be recognized. You must have seen from the slide 1, over the last several years, we have achieved 17 million square feet of delivery. We're talking about doubling our delivery in the next 24 months based on ongoing activities. It's not only aspirational delivery volume. So that should actually present a very strong revenue recognition potential for us. Looking a little longer, all the cumulative volume that we have sold till March 21 or December 21, my apologies. December 21, the cumulative volume that we have sold should help us achieve nearly 2/3 of our projected revenue over the next 3 years come from the sold volumes. That basically means we have a very strong visibility on the volume that are going to be driving this revenue recognition. So as long as we complete and hand over, we should be able to revenue recognize. That's why we are focusing on execution now. And as I said a few minutes ago, we believe we are on a right track. We should be able to achieve our completion and handover targets, as I said a minute ago. So overall, a very robust financial outlook we have, and we are on a path to recovery in FY22. And our efforts over the last 2 years or 3 years have endorsed that fact. And if you would have seen the ROC chart. A couple of years ago, when we first interacting with the external capital market investors, the question was, what is a sustainable operating margin? Will you scale up nicely or is it only aspirational? Will you reach a steady state operating margin which is comparable to industry average or at least a resi player margin? Where will you reach our ROC? We believe over the last 2 years we have managed to prove or demonstrate our progress on all of the 3. We scaled up from a less than 1 million square feet annual volume in pre-RERA environment to 3.5 million square feet steady state volume over the last 2 years. We are now fully set, the machine is well oiled, platform is set, and therefore we believe we should be able to rise from this 4 million square feet in FY22 to 5 million and then reach at 20-25% CAGR annually. We've also, apart from ramping up and stabilizing, we've also kind of shown the improvement in operating margin over the last 2 years. We have already reached the 20-23% operating margin, EBITDA margin. We believe we should be able to stabilize in the mid-20s. ROC, we used to be about 3-4% ROC a few years ago. You would have seen the chart in slide 16. On an audited accounts basis, we were already at 7.4. We expect to see a double-digit ROC fairly soon. We believe we should be able to stabilize around mid-teens in a foreseeable future. This last couple of slides, I'm not obviously going through the industry outlook. All of you are experts in it, and we learn from you, and therefore I don't want to be investing your time into explaining the sector. It just suffices to say the sector seems to be on the cusp of a new growth era. It's actually in a sweet spot today because of a variety of fundamental factors which all of you know and you keep writing in your research, and therefore we read from there. Therefore, I don't want to invest your time into explaining them. It is suffice to say, large branded player is a theme in the market. We have established ourselves as a large branded player over the last several years. We are reaping the benefits today. The consolidation is going to continue, and we believe, therefore, the ground is well set for us to be able to continue our growth momentum. Just looking very briefly on the last 2 slides, slide 22 just summarizes what our strengths in the markets are, what we are thinking of doing. We are continuing our strategy that has helped us grow. We are actually unlocking value from our Bengal. We are going to focus on DM as a growth accelerator. I will take some of the questions on DM and Bengal in the Q&A, but I just wanted to draw your attention to slides 23 and 24, which explains more about what our unlocking strategy in Bengal is and how do we see DM model as a growth engine for us. With that, I just want to summarize saying very strong brand, well-governed company, trust, transparency, governance has been a pillar for Shriram Group, and that applies to Shriram Properties as an integral strategy for us. Proven track record of growth and improving profitability by now. Strong growth outlook, not just for the sector, but also for us, supported by a pipeline of projects, which is growing as we speak. In a positive industry environment, with a strong balance sheet, we believe we should be able to grow and deliver value for our shareholders. I'll stop here, and I will be very happy to take questions from you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Biplab from Antique Stock Broking. Please go ahead, sir.
Good afternoon, sir. Hope all is well. Sir, my first question is regarding your business model. You have, DM and JDA, mostly DM, JDA projects. Could you give us some color, like what proportion of your sales sales booking that you do, what proportion of that is from DM and how much from JDA?
Yeah, I'll make an attempt and then my colleagues will join me.
And
so
also, sir,
overall on a 9-month basis.
Yes, sir. Sorry.
So JV and JDA is accounted for about 50% of sales volume during this year. DM accounted for 38% of sales volume during this year. But more importantly, on a overall pipeline basis, if I look at, right, that determines what's our overall outlook. About a third is DM, and about 40% is between JVs and JDAs. So that's fundamentally how we are spread from a long-term perspective as well.
Okay. Okay. And sir, typically, what is the DM like? How much? Typically, how much do they? How is the structure in your case DM? Because how's the DM like? How much do share and what are the responsibilities like that you have in DM projects?
Yeah. So as I said, we have about 13 DM projects signed already. There are some in the pipeline. When we started charging DM fee, which is core marketing and CRM activities and project management. For that, we used to charge anywhere between 12% to 16%, or actually 10 to 16%. Our median DM fee till recently was about 12%, which primarily goes up if we have to absorb additional costs, which means, as I said earlier, we do end-to-end, right? We provide our product design, development, marketing, our brand, marketing, sales, collection, construction, and handover. If the selling expenses and everything has to be borne by the landowner company, which is the DM company, we then collect only the fee for marketing, CRM, and project management, which is averaging around 12% on a weighted average basis for all the signed contracts. If we have to absorb the marketing cost to Shriram, we simply gross that up. So therefore, some of the contracts which actually go up all the way to 20% as well, depending on what all we add and delete. But it is suffice to say on a comparable basis, if I have to say what is your core DM fee, which is only manpower cost will be the cost for you. What is the core DM fee? It will be 12%.
And sir, what are the responsibilities? Like, do you have to suppose there is a project? I am the landowner. I come to you and say, sir, you do my project. This is my land. You do the DM projects and all. So whose responsibility it is to get approval, to get funding, like debt funding, and in RERA, would you be the co-promoter?
It's Ramesh. I'm replying your query. First thing is, we take up, depends upon the kind of opportunity. In some cases, landowners may come to us who himself is a developer with approved project also. So once approved project comes here, depends upon the kind of design which we have, we'll take up the project. If there's any design changes there, then we suggest them. So design change is also done. So approval also, we take up the responsibility in case it is necessitated for the project sale. This is regarding the approval. As my colleague said, we take end-to-end from the project design, approval, construction, handover, and some cases maintenance as well. So this entire gamut will be taken by us. In one or two cases where it's a pure marketing, we do only the marketing and CRM related and handover related things will do it. So generally the few claimings we take up from the beginning to end-to-end spectrum we will consider. As far as the funding is concerned, depends upon the project viability. We decide what fund is needed primarily to fund the working capital requirements of the particular project. Normally, we don't allow any kind of fund outflow from the project other than what is required for the project. So the funding, in some cases, we take up the responsibility. We may give certain guarantee, depends upon the cash viability of the project. Other cases, it is a responsibility of landowners themselves. Fair questions. In terms of the RERA, because as we are explaining, the entire sale and construction is done by the landowner company only. So legally they are the promoters. In any case, we are service provider. We are registered under the service provider also, and we are commercially responsible for it. Legal responsibility will be with the landowner. Since our brand name is at stake, we ensure that all RERA complaints, including filing and tax filing, will be controlled by Shriram Properties, the development manager. Hope I could answer all your three queries.
Okay, that's great. One final question, if I may, please. On Kolkata, can you, you have presence in Kolkata. What my understanding is that Kolkata is a market where the pricing has not seen much escalation for many years. And also the volume has not been increasing as we may have seen in other cities. Can you give us some insight on this? How's the market overall, Calcutta as a real estate market?
Yeah, this is Murli here. Calcutta as a market has been extremely positive and good for us. We have launched phase 1 which is about 2 million square feet, about 2,300 apartments. Grand 1, which is called Shriram Grand 1, which we have fully sold. We are hardly left with any inventory. We start handing over the apartments by April. So there is a good response to that. And phase 2, it's again, it's called Shriram Sunshine. So it's got about 3,200 apartments. Phase 1, we launched about 1,200 apartments. We have already sold about over 800 apartments in that. Phase 2, we have launched again another 1,200 apartments. Again, we have got a good response so far. Calcutta, we have done exceedingly well. And the location of our land is very, very strategically located. It is about 20 minutes from Howrah by train and also well connected through the highway. As we speak now, we have got tremendous response for all the housing offerings. And also, we are in active discussions with people who are interested in setting up warehousing in our location. We are in active discussions on that. So we'll come back to the market soon with output on what is happening on the warehousing development. So people have shown a lot of interest in buying large fraction of land for warehousing and data center. So Calcutta, we remain extremely bullish and positive.
Okay, that's great, sir. Thank you, sir. Thank you so much.
Just to supplement one last message, I think some of the publishers, you talked about Kolkata volumes have not grown. I think whatever we read from the public reports, like Anurag recent research also talks about the strong volume momentum in these markets. So that's consistent with what we are seeing on the ground. The market has actually been reasonably active and vibrant. Just wanted to point out.
Okay, okay, sir. Thank you, sir.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1 on their touchtone telephone.
Hello. Yeah. So this is Aditya here again from ICICI. Sir, if you would just elaborate on sort of price hikes we have taken across projects in this year. If you could break it up between plots and apartments and how it has been across different cities in Bangalore, Chennai or Kolkata. If you could give us some perspective how you are also handling the input cost inflation. That is my first question.
With respect to the price increase, we estimate the price increase to take place steeply. I would estimate maybe in the next 9 to 12 months time. Price increase could be about 10%, particularly in Bangalore and Chennai markets. Calcutta, we expect the price increase to happen at least about 8%. That's my estimate in the next 12 months time. Some of our projects, we have increased the price in the last 2 quarters. And we also expect to increase the price in the next quarter also in some of our projects. So in overall, we anticipate in the next 6 months time, price increase of at least about 5 to 8% across all the projects. So that's what we expect. Both plots and apartments, there has been a constant demand. Hence, we are looking at increase in prices.
Okay, sure, sir. The next question is basically on our unsold inventory. As you mentioned, we don't have much inventory to sell and we'll be looking to launch new projects. You could just broadly share with us the unsold inventory levels, like how many months or what is the value of this unsold inventory and what is the value or area of the projects we are looking to launch in the quarters going ahead in order to achieve our guidance, which we have stated.
As you have seen, last 9 months time, we have launched 5 new projects, over 2 million square feet. We have done 45% on sale, which is one of the best benchmarks across the industry. We have a very healthy trend of project sales at launch. So since we are catering to big market and affordable housing, where there is a tremendous demand, and as a brand, we have a very strong credibility in the market. We have been able to sell the projects whatever is launched. So one such example is that last 9 months time, first 9 months of the year, across 5 projects over 2 million square foot, 40% on sales is a excellent number. So hence, we have close to zero inventory on the projects completed. Gopal can give you the specific numbers.
Yeah. So on the launched project, as I said, 26.3 are ongoing projects, out of which 22 million is launched, and of which 2.67 million square feet is the inventory as at the end of December. Will add to a potential sale value of about 1,200 to 1,300 crores as a unsold value in these projects. And the additional 4 million square feet can come from these ongoing projects alone in terms of their multiple phases can be launched. So we have a 4 million there, and we obviously have our projects under development. If I look at a specific launches that we are planning for, as I said earlier, we are looking at 3 launches from 3 new launches in Q4, and we also prepared enough for 3 to 5 additional phases of our own ongoing projects. So 3 projects, new launches that we are talking about would be adding to about 1.25 million square feet of saleable area, which we believe we should be able to launch in Q4, remainder of Q4. Additional ongoing projects, as I already told you, 2.67 is the unsold inventory from the launched projects. 4 million is the not launched projects from ongoing, out of which we think we can be prepared to launch about 2 million square feet if the market window permits. So we have only 45 days right now. Otherwise, they'll slip into Q1 of next year. Apart from that, we have 8 launches planned in FY23, aggregating to about 3.6 million square feet, based on projects that we have already formed up or signed up already. So they would have a revenue potential of somewhere close to 9,000 crores or thereabouts.
Okay. Oh, sir, that was pretty helpful. And sir, with this Omicron impact and everything, so are we still confident of achieving this 4 million square feet guidance? So what are the upside or downside risks to that number? That is my last question.
We should be able to achieve our estimated number. We have made a lot of measures in managing this COVID. In fact, pre-COVID, we had about 4,000 laborers approximately. Now, we have got about over 5,300 laborers across all our sites. And we have taken a lot of initiatives in ensuring, educating the laborers to take vaccination. We have conducted vaccination drive. So I'm trying to keep all our workers on site very, very healthy. So we should not have any major impact because of the COVID impact. So we should be able to achieve our numbers comfortably.
Okay, sir. That was very helpful. That's it from my side, and thank you and all the best.
Thank you, sir. We have the next question from the line of Biplab Debbarma from Antique Stock Broking. Please go ahead, sir.
Sir, thank you for taking my questions again. If I'm not overshooting the time. Sir, 2 questions. One is, sir, what is the on-ground market scenario like in the 3 cities that you are operating? How are you seeing better traction? I mean, just like just wanted some insight. Like, what are the sweet spots in each of this market? How things are different in terms of inquiries earlier compared to now and say pre-COVID or say 1 year ago, and what kind of interest you are saying? Like when we saw a rebound in real estate residential, we saw that customers inclination towards completed projects or nearing completion projects. So now, what are the trends and traction that you are seeing in terms of ticket size, what are the sweet spots, what kind of project do they prefer, how are the inquiries level, and how are the conversion levels in each of these 3 cities? Thank you, sir.
So how the market dynamics have changed?
Okay. The post-COVID, particularly, immediately after the COVID, there has been some kind of a concern. But, things have changed quite a lot. there has been a good demand which has come up now. A lot of people who were not looking at buying homes, they all come into buying homes today. So the demand has only gone up post-COVID now, particularly on the mid-market and affordable housing, or where the first-time home buyer is looking at. The demand has substantially gone up, and across all the markets, whether it's Bangalore or Chennai or Hyderabad or Calcutta or Pune. So where we are operating, the demand has gone up post-COVID. So we are also seeing good progress in absorption of all our projects across the cities.
Hello.
Yeah, please go ahead.
No, sir. I'm also saying, like, what kind of are customers still preferring the ready-to-move-in inventory, nearing completion inventory, or slowly you are seeing increasing share of customer interest in under construction or in newly launched projects?
On the mid-market and affordable housing, there is a continued demand for the projects which are under construction. For the luxury projects, people prefer to have finished ones. That's what is a trend today, because on the mid-market and affordable housing, customer also needs some time for him to mobilize to meet his aspirational home. Hence, there is a strong preference for projects under construction on the mid-market and affordable housing segment.
And sir, what would be the typical sweet spots in each of this market that you are selling?
Bangalore, Bangalore on the apartments, it is somewhere between 50 lakhs to 1 crore. In Chennai, it's again 40 to 80 lakhs is Chennai. In Calcutta, it's between 30 and 60 lakhs is what we are seeing, a big demand. On villas, across all locations, it's about 1 to 2.5 crores.
So you continue to remain upbeat. Things are outlook is quite positive for real estate in this market.
Yeah, we have a very optimistic view.
That's great news, sir. Thank you, sir. That's all from my side.
Thank you, sir. We have the next question from the line of Soumya Sarkar from JM Financial. Please go ahead.
Yeah, so congratulations on great Q3 numbers. So I just had one question pertaining to the DM model. So this is regarding, like, as you told, like, I'm clear about the fees and all. It's like 12 to 16%. That's fine. So you told about there is a cash waterfall to the landowner. So I just wanted to know, like, can you just throw some light on the cash waterfall and what kind of margins can we expect to unlock after the waterfall, just pertaining to the DM model? So just about this.
So there are two ways to look at this. One is from our perspective as a DM partner, as a DM service provider. For us, the 12% is a clean fee minus my allocated manpower cost will become the EBITDA or a PBT, because there is no other cost, so it flows through. So based on our experience, we believe this 12 minus our allocated manpower won't be more than 2% or thereabouts. So we're talking about 9.5 to 10% of PBT from this business, as a percentage of project revenue. As you know, we recognize only the fee income, so the EBITDA margin will be very high. I'm not getting into that, it's because it's really pass through. So 75% plus of that fee should be our PA flow through. From a landowner perspective, it's actually, therefore he's paying us 12%, and we believe the EBITDA margin, we don't do projects which have EBITDA margins of anywhere less than 25% or thereabouts. So therefore, from his perspective, even after paying DM fee, he gets his value unlocked very comfortably. In fact, we can share this data with you if required. We've done comparative models between DM, JDA, own, and ORP. These are the four options available for a landowner. On a cash flow basis, because he gets the entire residual waterfall, right? So from a collection perspective, if you look at, first collection goes towards statutories, then construction payment, and other contractor payment like marketing bills and including DM bills, and then therefore rest is to his account. So statutories would include all the taxes, interest, all the servicing requirements. So that cash flow is to him. So if I look at an NPV cash flow basis, if I look at the DM actually generates the second highest cash flow compared to other alternative formats of development from his perspective. The only other way he can make more cash flow from the same land parcel would be the own development, which in today's market is not happening because smaller brands or smaller developers are not able to develop on their own. Therefore, it is even superior than JDA from his perspective, because in JDA, we fix the land value upfront, and therefore you determine the revenue share or a space share. As you could expect, any commercial organization will take their own risk weighting. Therefore, you fix the price. So there is a lot of cost aspects involved. There is a lot of land value judgment involved. So both parties play conservative, and therefore there can be a disconnect. And whereas in DM, all the upside and downside belongs to him, so they have a comfort and confidence that they are playing the market properly. So therefore, we believe this DM will be a value accretive or a win-win for both a service provider like us, as well as a landowner like the DM landowner. And that's why we believe it is a sustainable business model on the long run.
To add further, this is not only when we embarked upon DM, we thought about it. In fact, when we started the journey from 2018 to 2022, we have completed one residential project where we could prove to the landowners that they got a better money than one of the cases, which were completed. In another two plotted projects also, we were able to establish they are able to reap better benefits by this. So it's not only theoretical, in terms of the actual practical work which will be done on ground, they are able to reap that kind of money for the landowners.
That's an important point. I forgot to mention that. So for the benefit of everybody else on the call, so we have gone through the whole full life cycle of the DM projects by now. 3 years ago when we started DM residential, a lot of question marks were raised. Today I think we are in March, April, our first residential DM will be ready for completion and hand over to customers. So that means we have gone through right from the land approval stage all the way to the completion and over the entire learning curve with the partner. So we know now how to overcome or iron out any differences that can arise. Our first plotted development project, Shriram Earth, Mysore, all our plotted development is sold in the brand name of Shriram Earth. So Shriram Earth, Mysore Road is also ready for handover. And registrations have begun, and we should be completing the process during this fiscal. So all this gives us a good comfort and confidence that we can actually manage this DM model smoothly without risking our brand. That may be one of the concerns that people had. So we don't give control of this project to anybody. We run the entire end-to-end control with us, like as if it's our project, and therefore brand risk is minimized.
Okay, sir, got it. Thank you. That was quite detailed. Thank you so much.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
Yeah. Thank you very much, everyone, for being on the call, and it was a pleasure talking to all of you. And we look forward to your support as an analyst as well as an investor in the buy-side community. We are new on the block on the exchanges. We look forward to your support both in terms of helping us sail through these whole capital markets, and request your support in terms of coverage. We are happy to remain engaged with people after this call as well to see how we can explain our investment case more appropriately that allows you to have a view on the company and explain it to your investors and clients. For the buy-side investors who are on this call, thank you very much for the support that you have extended through the entire journey, IPO journey, and also thank you for being on this call. On behalf of the entire management team at Shriram, we sincerely thank you for joining us and look forward to interacting with you more often in future. Thank you.
Thank you.
Thank you. On behalf of ICICI Securities, that concludes this conference call. Thank you for joining us, and you may now disconnect.